Hey everyone, and welcome. I am absolutely thrilled to have you here for today's explainer. Now, today we are unpacking a financial report that honestly presents a completely fascinating puzzle. We're looking at the Q3 2026 earnings report from Cracker Barrel Old Country Store. And let me tell you, when you first glance at these numbers, they kind of seem to defy the very laws of business gravity. It is an absolute earnings paradox. So we're going to use the data straight from their quarterly filings to make sense of exactly what is happening behind the scenes. Let's dive in.
Okay, so when we think of Cracker Barrel, most of us instantly picture rocking chairs, that warm country hospitality, and, home-style food. It's a beloved American brand, and its roots go all the way back to 1969 down in Lebanon, Tennessee. But for today, we are stripping away the nostalgia. We're looking purely at the cold, hard math of their third quarter for fiscal 2026, which wrapped up on May 1st. We're taking a real deep dive into the financial health of this legendary chain to uncover a story that the headlines alone they just don't fully capture.
So here is the absolute head-scratcher we are solving today. How on earth do you triple your profits while simultaneously losing sales? Think about that for a second. If you run a business and fewer customers are walking through your doors and they're spending less money overall, your profits should naturally go down, right? I mean, that's just basic economics. But in this specific quarter, Cracker Barrel somehow pulled off this exact magic trick. And the way they did it, it's honestly a masterclass in reading the fine print of corporate finance.
Just look at these numbers. They perfectly illustrate this paradox. Up on the top line, total revenue actually dropped by 2.9% compared to the exact same quarter last year, landing at $797.4 million. So they literally took in less money at the register. But then you look at the bottom line, and GAAP net income soared by an astonishing 240%. It skyrocketed from $12.6 million last year all the way up to $42.8 million this quarter. Shrinking sales, yet profits more than tripled. How is that mathematically possible?
All right, let's start peeling back the onion in Section 1, the litigation windfall.
Boom, here is the smoking gun. It's a single number, $47.4 million. You see, Cracker Barrel's massive profit jump wasn't driven by, selling a record number of diskettes or flying through retail merchandise. Nope. It was actually caused by a $47.4 million payout they received, net of legal fees, by the way, from a settlement agreement resolving some interchange fee litigation. This was a huge, one-time cash injection that just hit their income statement all at once. Because of this windfall, the baseline profit numbers for the quarter are completely skewed. It paints this picture of explosive growth that, quite frankly, just isn't coming from their day-to-day restaurant operations.
Now, this brings up a super important concept if we want to really understand corporate earnings. You'll hear companies talk a lot about GAAP metrics and adjusted metrics. GAAP stands for Generally Accepted Accounting Principles. It's essentially the strict, standardized rulebook, and it absolutely requires companies to include one-time events, like that giant $47.4 million settlement. But management will usually also give you adjusted metrics. These numbers intentionally strip away the noise of those rare one-off events to show you the true underlying operating performance of the business.
So, how does this actually play out for the folks holding the stock? Well, if you just read the GAAP headline, it looks like Cracker Barrel made a wildly impressive $1.90 per share in profit this quarter. Amazing, right? But when we look at the adjusted diluted EPS, which yanks out that one-time settlement money, the actual core business generated just 29 cents per share. That is a staggering difference. We're talking a drop from $1.90 all the way down to 29 cents once you remove the legal windfall. That totally changes how we view their quarter, doesn't it?
Moving right along to Section 2, Core Business Performance.
So if we strip away that settlement money, what's actually happening inside the stores? Their adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, gives us the answer. It's really one of the best metrics for looking at the raw cash generated by daily operations. When we compare Q3 of the previous year to this year, adjusted EBITDA actually dropped from $48.1 million down to $40.3 million. So despite that huge headline profit we just talked about, the fundamental profitability of their daily operations shrank by nearly $8 million year over year. They're clearly facing a pretty tough operating environment right now.
And the reason those operational profits shrank? Well, it becomes pretty clear when we break down their comparable store sales, meaning sales at locations that have been open for at least a year. Across the board, they saw slight decreases. Restaurant sales were down 2.6%, and retail sales were down 1.8%. Basically, this tells us that compared to the exact same period last year, they had a combination of less foot traffic and reduced spending per guest across both of the main segments inside their physical stores. Let's dig into that split in Section 3, restaurant versus retail.
Okay, so this breakdown actually settles a really common misconception. When you walk into a Cracker Barrel, you are immediately greeted by that huge, expansive country store full of retail finds. It's a massive part of their brand identity. But looking at the actual revenue mix for Q3, the restaurant segment completely dominates. It makes up 82.6% of their revenue, pulling in an incredible $644.3 million this quarter alone. The retail side, while famous, accounted for just 17.4% of the pie, or about $138.9 million. So food service is undeniably the giant engine keeping the lights on.
To ground these financial percentages in physical reality, let's just consider their footprint for a second. By the end of Q3, there were 657 company-owned Cracker Barrel stores operating across 43 states. Think about that scale. When we talk about a 2.6% drop in restaurant sales, we aren't just talking about a couple of locations having a slow month. We're talking about a macro trend stretching across more than 650 vast restaurant and retail hybrid operations. It's a big deal.
Which brings us to our final part, Section 4, Upgraded Future Outlook.
Now, with the declining core business that was basically bailed out by a one-time legal payout, you might expect management to be sweating, right? But the tone from leadership is actually quite the opposite. Listen to what Cracker Barrel's president and CEO, Julie Masino, said. Our initiatives to improve operations, deepen guest connection, and enhance profitability continue to gain traction, with strong execution from our teams driving third-quarter results that exceeded expectations. She goes on to say they're well-positioned to sustain this, quote, new momentum. So despite those dropping comparable sales, their internal operational and profitability initiatives are apparently beating their own internal targets.
Now, they are definitely putting their money where their mouth is with their forward guidance. They significantly upgraded their outlook for the full fiscal year of 2026. They bumped up their total revenue expectations slightly, targeting between $3.27 and $3.30 billion, but the real shocker? The adjusted EBITDA target. Their previous outlook projected a high end of $100 million. They have now drastically raised that target to sit somewhere between $120 and $125 million. Management clearly, confidently believes their core profitability is about to experience a major rebound.
So why this sudden confidence? It's all about cooling costs. Previously, they anticipated commodity and hourly wage inflation to sit somewhere between 2.0% and 3.0%. Now they've revised that down. They expect inflation in both ingredients and labor to settle in the low 2% range. And look, when you operate 657 massive restaurants, even a tiny fraction of a percent decrease in the cost of food and the cost of labor, that frees up significant breathing room for profit margins. It's a real game changer for them.
All right, which brings us to our final thought. The data we've unpacked today shows this fascinating tug of war. Cracker Barrel posted an incredible headline profit, sure, but it was driven by a one-time litigation windfall while their actual daily sales slightly declined. Yet cooling inflation and new operational efficiencies have management highly optimistic about their future margins. So I want to leave you with this question. Will better profit margins and a one-time cash windfall be enough to sustain them, or will this operational momentum ultimately need to reverse the trend of declining customer sales in the long run? It is a brilliant business case study, and one we will for sure be watching closely. Thank you so much for joining me on this explainer, and I can't wait to dive into the next set of data with you all soon.